Fraud rarely starts with a smoking gun. It begins with subtle signs and silent behavior. In session 3 of our fraud awareness and prevention series, we dive deep into the psychological red flag and behavioral pattern that often precede fraudulent activity. The title, Spot the Sign, suggests we'll be looking at the indicator or warning sign that can tip us off to potential fraudulent activity. The image on right hand side depicts a magnifying glass examining suspicious documents, conveying the idea of close inspection and investigation. We want to emphasize that fraud can be difficult to detect, but that by being vigilant and understanding common fraud tactics, we can improve our ability to identify it. The overall message is that recognizing red flag and understanding human psychology are key to successfully uncovering and preventing fraud. The session agenda outlined the key topic we will cover today to help you recognize and respond to potential fraud. First, we will discuss the common red flag in documentation, processes, and systems that may indicate fraudulent activity. Next, we will look at changes in employee behavior, lifestyle, and work pattern that could signal potential fraud. We will then explore the latest insight from the ACFE 2024 report to the nation on occupational fraud. Finally, we'll examine real world case studies and apply fraud detection technique to potential scenarios. This agenda will provide a comprehensive overview of fraud systems, indicator, and best practice for prevention and responses. Documentary red flag are early warning signs that can indicate potential fraud or misconduct. I will cover three key areas to watch out for: financial anomalies, procurement warning, and system process issues. Financial anomalies include missing or altered documents, unexplained account adjustment, unusual invoicing patterns, and duplicate payment. Procurement warning encompasses repeated use of single source vendor, contract changes without approval, split purchases to bypass threshold, and vague vendor service description. System and process issues can include overriding control without documentation, unusual transaction timing, excessive manual processes, and delayed reconciliation. These red flags are often the first sign that fraud scheme may be in operation. So it is important to be vigilant and investigate further if any of these issues are identified. Tips from employee, customer, vendor, and other remain the most common way fraud is initially detected, accounting for 42% of the cases. Internal control like internal audits and management review also play a key role, detecting 60% and 12% of fraud cases respectively. Other detection methods include account reconciliation, document examination, external audit, and discovering fraud by accident. These data underscore the importance of having strong internal control and a culture that encourages people to report suspected misconduct. Effective fraud prevention requires a multi-pronged approach that combines robust processes with an engaged workforce willing to speak up. The fraud triangle outlined the three key elements that motivate fraud: pressure, opportunity, and rationalization. Pressure can come from financial difficulties, addictions, lifestyle maintenance, or unrealistic target. These create the initial motivation to commit fraud. Opportunity arise from weak internal control, excessive trust, poor segregation of duties, or indicate oversight. These vulnerabilities enable the fraud to take place. Rationalization allows the fraudsters to justify the action to perceived entitlement, belief they are just borrowing temporarily, or the notion that everyone does it, so why can't I? Understanding these three interconnected elements help identify potential perpetrator and opportunities to strengthen control and prevent fraud. Behavior red flag can indicate potential fraud or misconduct within an organization. These red flags often manifest in changes to an employee lifestyle, control over their work, attitude, and stress level. Unexplained wealth, disappearing financial problem, and living beyond means can signal illicit activities. Unwillingness to share duties, refusal to take time off, and unusual work hour may indicate a desire to conceal wrongdoing. Defensiveness, irritability, and close relationship with suppliers, customer can point to a guilty conscience. Anxiety about audit, complaints about lack of authority, and fear of losing status may reveal an employee trying to cover the track. The ACFE reported 2024 reported identified the most common behavior red flag observed among fraudsters. Leaving beyond means is the most frequently observed indicator presently in nearly 40% of cases. This could suggest the fraudster is using stolen funds to support an extravagant lifestyle. Financial difficulties is the second most common red flag seen in 25% of cases. Fraudster may turn to theft to address personal money problem. Unusually close relationship with vendor present in 20% of cases can indicate collusion or kickback. Control issues and unwillingness to share duties at 18% may allow the fraudster to conceal their activities. Other notable red flags include divorce, family problem 15%, and a wheeler dealer attitude 12%. Understanding this common behavioral indicator can help organizations detect and prevent fraud. These case studies highlight the importance of being vigilant for red flag even with a long tenured and seemingly trustworthy employees. Jane, the finance manager, had access to the critical financial statement and vendor relationship, which she exploited over 7 years to embezzle pound 450,000 through fake vendor payments. The red flag include her reluctance to take extended time off, insistence on handling certain vendor relationship personally, recent purchase of a second home, and defensiveness toward new financial control. It was only during Jan extended sick leave that a replacement discovered the fraudulent invoices and shell companies she has created. This underscores how a fraud can go undetected for years, even in organizations with experience and trusted financial professional. Robust financial control, segregation of duties, and regular review are crucial to mitigate such insider trade. Fraud is often committed by first-time offender with clean employment histories. They don't see themselves as criminal, but as ordinary people in difficult circumstances. Fraud scheme typically last 12 months before detection. The longer a fraud continues, the more financial damage it causes. Understanding the psychology behind fraud is key to early detection and prevention. Many fraudsters start with a small transgression that grows over time. Fraud detection is critical responsibility for all employees. Stay vigilant, be aware of both documentary and behavioral red flag in your daily work. Trust your instinct. If something seems unusual, don't ignore potential warning sign. Remember that tips from employees are the number one method for detecting fraud. Use the company whistleblowing procedures or speak to your manager if you have concern. Always adhere to internal control and don't create workaround even when pressed for time. Control exists to protect the organization and its employees. In next section, we will explore how to prevent fraud and detection in an organization. For any assistance or advisory, please contact HMD Associate at zahid.d at hmdassociate.co.uk or connect with Zahid Dohodwala on LinkedIn. Thanks.